are okay to start. So welcome for the webinar about passive investing. My name is Arthur. I teach at Wintech here in New Zealand. My background is all about IT. And since 2016, I became an investor. And more recently, about the passive investing strategy that is all about our topic today. So the idea is that I will be using the website so you can later on take a look in the same material as you are having now. And I will move through the sections as we progress. So basically, the passive investing strategy is the one that you don't waste your time looking at the market or following the news or trying to find the next big company. You just buy something, and I will explain, of course, and then you almost forget, okay? So, but before getting to those details, I need to present why investing is important. So basically, two reasons. The first one is you want to get rich working for others or even for yourself every day from 9 to 6 p.m. You need to have people, you need to have companies working for you. So probably investing is the fastest way to you to have people, to have other companies working for you, not only your own effort. The second, my reason, and I hope you can see my screen, is that in order to get a decent retirement, you need to put your money to work for you and wait the compound interest to act on that, okay? So those are the two main reasons why invest. But I also want to show you guys what you need to have before starting investing. So I would say two main things. The first one, do not have liabilities, meaning, let's say if you have your home mortgage or if you have a finance of your car, it would be better if you can eliminate those debts and then you start investing, because probably the return that you might get with your investments might be lower than the interest that you are paying to the bank to get your mortgage. Okay, so first idea, eliminate or at least try to reduce your debts, your liabilities. The second main thing here is do not invest if you don't have an emergency reserve. So what is that? Let's say, what if you lose your job? What if you get sick? What if someone in your family got an accident? So you need to have some money quickly available to cope with those expenses. So a reserve emergency that we recommend here is to have at least 3 to 6 months, 6 times your monthly cost, so you can deal with those situations, okay? And by the way, in the beginning, I forgot to mention that everything that I'm showing you here, do not take as investment recommendations. Is more about the strategy, the approach, and what you can do with that. Every single person needs to understand your own goals, your own situation, so you can select your own investments, okay? So this is more of a financial education than, of course, investment recommendation. By the way, I'm not an authorized financial advisor, okay? Good. So now that you know what you need to have before investing, I would like to show you what might be some goals that you could have as an investor. Let's say let's see some examples here. Maybe you want to preserve your capital. Maybe you have something and you don't want to lose that. So one objective might be to preserve the capital that you accumulated. Another example might be to protect your capital against inflation, that is the hot topic of the moment, or even devaluation of your currency, might be New Zealand dollars, for example. So there are some, you can set up your financial goal as protect against that. Another example might be to get some passive income. And passive income is to get like every month something, some money in addition to your actual job. Maybe because you have investments, maybe someone is paying a kind of rental, and then you are getting that every single month that you might use or you might reinvest it. So there are some investments that provides you a passive income. And note here that passive income is different from the passive strategy, okay? But I will get into that in a few time. Another example might be to monetize your capital. Let's say you have some money, now you want to invest, and of course you want to get return. You want to get profit over that, okay? So that might be another goal. So, and it might be a combination. Maybe you want to preserve against inflation, but also to monetize that. Good. And the other thing that you need to know is what is your investor profile, okay? Maybe you are very conservative, the one who cannot see the investment balance going down, or if you, let's say, invest 10,000, you will not stand to see less than that amount in your portfolio balance. So that is to be very conservative. The second one is a moderate investor. Maybe you are okay if there are some drawdowns in your balance, but that should not be so big, okay? You are okay if, let's say, you have 5% negative in some point in time, maybe 10%, but you cannot support getting 20, 30, 50%, as we had during COVID pandemic. And the third one is the aggressive profile. The one who is okay with those major drop downs because he or she knows that maybe there are some opportunities. If I buy more when the market is going down, it will be even better for me. So just let you know what is your investor profile. Good. So going back to our main page, and again, feel free to put questions in the chat or in the question and answer sessions, although I'm not checking that all the time. So, and then finally, why invest in the passive way? So again, two main reasons. The first one is if you cannot beat the market, maybe it's better to join it. So probably you have heard someone saying, oh, I want to beat the market. I want to get more return than the average mark. So those investors, they are trying to timing the market. Maybe they want to find out what will be the next company, the next Tesla, for instance, or maybe they want to sell when something is high and then try to buy that later on when the prices drop. So, but I would say, as per the studies that we have, that strategy doesn't work because in more than 80% of the cases, the active strategy lose to the average market. So sometimes it's better to just buy the entire market, and that is the main idea of the passive strategy. You buy the entire market, might be New Zealand index with 50 companies, or might be US index like the S&P 500 with 500 companies, or maybe both. You buy the entire market, because in the long run, you will be better than 80–85% of the investors. And I can show you some statistics about it. So if you go here, you can see a report that we have every single semester. And this is the end of 2021, saying that how the fund managers performed against the index that they are benchmarking. For example, let's say US. In US, if you take the last 10 years, 83% of the funds in the US underperformed the S&P 500. So it means that just 17% of the fund managers actually beat the US market over there. And the figures are not different if you take shorter periods here. For example, if you go to Brazil, we have the Ibovespa index over there. And in the last 10 years, 86% of the investors or the funds there underperform the Ibovespa index. That is quite bad, I would say. So, and that same idea repeats all over the places, like Europe, 84% underperform the local index. Canada, similar situation. Australia, a little bit better, but still around 80% of the fund managers there, the active ones, they underperform the local index that is ASX 200. Okay, so all the countries, you will see the same behavior. So why do you think you will be that 15–20%? The idea of the passive strategy is you buy the entire market and then you will get the average returns. But in the long run, as per the numbers here, you will be better than 85% of the investors who are trying to beat the market. Okay, going back there, let's see the other reason why to go for the passive investing. So the other thing is, do not waste your time trying to, as I said, to find the next company, the next Tesla. Do not waste your time following the news like this week, all the things that are going, the markets are going down. So do not spend your time trying to understand what's going on. Forget about that. Go for the passive strategy, buy the entire market and just live your life, okay? Or I would say, dedicate your hours to your current job, or maybe develop new sources of income. But of course, put your savings and the time to work for you. Let me show you guys what you might have. For example, if you take a look in this, maybe you have heard about the future value formula. I would say, if you ask me, is that a formula to be rich, to be a millionaire? I would say, yes, there is one, but this formula is the one that you get rich slow, not get rich quick, as we have so many YouTubers trying to sell you. So that is the future value formula. And it has basically three main components: your starting balance, the return rate, how much you are getting over your investments, and the time. Also, there is also the contribution. So maybe every month you contribute a little bit. So that is what I call the only formula that might work to you. That is the future value formula. And note here that time is the only one that is exponential. So the longer you stay invested, the higher will be your final balance. But let's go for a simulation here, okay? And later on you can try. So let's say if you start with 1,000, okay, $1,000 for instance, and let's say that every month you can contribute 1,000 to your portfolio, okay? And let's say that you can get 1% per month on average. That's not so easy, but is still feasible, okay? So 1% per month, it's like almost 13% per year because of the compound. So let's say 1% per month. And then let's say that you will be in that investment for 20 years, okay? So, but every month you are contributing 1,000. So by the end of that period, we estimated that you will have 1 million. So that is the formula to become a millionaire. There is no magic. You need to start. You can start even with 0 if you want, okay? But let's say if you put 1,000 every month, and do that for 20 years and manage to get this rate of return, you would become a millionaire, okay? Or, oh, I cannot wait for 20 years. I want something shorter. Maybe you want 15 years. That is, how many months is in 50 years? 15 years, I don't know. Anyway, it's about 170 something. So if you do that, but let's say if you manage to contribute 2,000, okay, 2,000, yeah, maybe it's a little bit more, maybe it's 180 months. I don't say, just a matter of multiplying. Yeah, probably is that. So, okay, if you want a shorter time, you need to increase your contribution, or maybe you need to increase your return rate, or maybe both. But again, there is no magic. See, if you want to achieve the same amount over 15 years rather than 20 years, you need to double your contribution, okay? Anyway, you can simulate things there. And also, let's say you want to maximize that. So what you can do, of course, you can increase your contributions, higher amount or a more frequent contribution, or maybe you can stay longer. So maybe if you can invest for 30 years, 40 years, it will be much better. Or maybe you can try to get something that on average will give you more returns, okay? So those are the only things that you can do. That, again, as I said, there is no magic formula, okay? Good. Later on, if you want to take a look, you can understand some of the concepts that we are discussing here. Okay, like what is rebalancing or something like that. Good, but let me go back to the main page again. So far we covered why to invest, what should we do before investing, what is the passive strategy, that is basically to buy the entire market and wait the time to act on that. And then finally, let's take a look in the 3 steps to implement that passive strategy, okay? For that, let me just see if I missed something before going to those 3 steps. Okay, so yeah, maybe this one, I would say, if you have a portfolio and that portfolio is passive, there are some features that you want to have, like, of course, your portfolio should be aligned to your financial goals. Remember that we saw them. And also your investor profile, maybe the aggressive or the conservative. It should be diversified. Don't put all your eggs in a single basket. Try to have different asset classes. Maybe you can have stocks, you can have bonds, you can have real estate, and also you can have different geographies. We mentioned here the New Zealand index, but you can go for US market, you can go for the emerging markets, such as Brazil, Mexico, China, and other countries. So you can have companies in those places as part of your portfolio. What else? Normally, passive portfolio is built with ETFs. If you never heard about that, ETFs are the same as a stock or a share in the stock market, but the difference is with a single investment, you buy more than one company. So as I said, the New Zealand 50 comprises 50 companies. So with a single investment, you can have shares of 50 different companies in New Zealand. So that is the local ETF. If you want to buy 500 companies, the S&P 500, you can buy in a single investment all those 500 companies, such as Tesla, Google, Amazon, and all those names. You can buy in a single investment the global markets with more than now 9,000 companies in a single fund. Okay, I will talk about that later on. And because they have more than one company, they are less risky, because what is the likelihood of all the companies to go for zero, for disappear? It's impossible to imagine that 500 companies from the US will go to zero. Okay, so that's the idea. It provides you less risk. It provides you simplification and diversification as well with a single investment. Okay, what else? Of course, the portfolio should look at the long term, but with an eye on opportunities. For example, since January, all the markets, New Zealand, Australia, Europe, US, Brazil, they are going down. Okay, so maybe because the market is going down, maybe it's time to, if you can, to buy a little bit more, because you are paying a lower price for the same companies. Okay, so you should focus on the long term, but with an eye to the opportunities. And other aspects here, rebalancing. So maybe you can, every time you will buy something, you can buy the thing that have listed performance. Okay, so let's say if you have 4 ETFs, 25% on each one, and now you have some money to contribute, you could go there and see, oh, what is my current balance? Out of those 4 ETFs, which one has performed the least? Maybe it's the emerging market one. And then you put your money and buy more of the emerging market ETF. So in that case, you are buying low. So you can do kind of rebalancing every time you contribute. So I'm not saying, for example, to you to sell units in the ETF that has outperformed the other, maybe US market, for example. I'm just saying, if you have money to contribute, go there and buy the one with the lowest balance in order to pay less for the same thing. Okay, and other aspects here. Good. Let me also show you guys one example that what might be, now that you know the ETFs, what might be one portfolio here in New Zealand, like a global diversified portfolio using the only 4 ETFs, in fact. For example, you might decide to have 25, and this is quite aggressive, I would say, because it's only about shares and stocks. It's not about government bonds or specific real estate funds. So you might buy 25% of New Zealand companies using this ETF or these other ETFs. So 25% of your portfolio, it's on New Zealand companies. The other 25 in Australia. So if you buy, let's say, this ETF from our stock exchange here, with a single investment, you will get 200 companies at the same time. For example, the big names from Australia, all the banks that they have there, the mining companies, okay? Let's say that you decided that you also want, let's say, emerging markets, okay? So you can have 25% in companies in countries such as China, Korea, Brazil, Mexico, okay, with a single ETF as well. And then let's say you also want to have the developed countries like US, Europe, Japan. So again, you can buy one of those ETFs or index funds, okay? Good. So that is the example. Later on, I will show you my own portfolio. Good. So now let's take a look in those 3 steps, okay? So if you go here in this last tab, you can see the steps. So the overall picture is just those 3 steps. The first one, as we explored, you should identify what are your investment goals. For example, do you want to protect capital against inflation, or do you want to monetize that? So, or a combination. So make sure that you know your investment goals. And then you would build a portfolio with assets that have the capacity to achieve these goals. For example, if I want, let's say, 10% or 12% or 13% on average per year of return, bonds will not be enough. I need to get something that is more risky. For example, the ETFs that buy companies shares, okay? So I need to build the portfolio that is aligned with my goals, but also with my investor profile, okay? Maybe I'm conservative, maybe I'm very aggressive. Good. The second main step is you should stay invested. So remember, do not try to time the market. Oh, now the market is going down, so I will sell my assets, sell my investments, and then I will return when I think the prices cannot go even worse. So the idea is stay in the market, do not panic, okay? What you should be doing is contribute periodically, maybe the same amount. Remember the 10,000 or the 1,000 per month? So if the market is down, like we have now, that is an advantage, because you are buying more with more units, more ETFs units with the same amount. Okay, so I normally say to people, and they don't get that right. If you are going to buy stocks for the next few years, in fact, you want the stocks to go down in price, not to go up, because if the price is going down, you can buy more and more with your same amount of money. Okay. So the second step is contribute periodically, maybe do that rebalancing. Remember, look at those ETFs and see which ones didn't perform so well and buy more of those ones. And then the third step is just do not panic. Okay, as I said, we had the COVID crisis and the crash in the market in March 2020. Now we are facing like 20% negative since January. So the worst thing that you might do is try to sell everything and panic because the negative news like inflation or interests rising or even political scandals in your country. So do not panic, do not follow those news, keep your strategy, keep buying as per your plan, and let the time act on that. So over the long term, you are supposed to get very good profit, because historically, everyone is getting if they stay invested for 10, 12, 30 years. Okay, good. So let's take a look in more details with each one of those steps. So remember, step one is all about identifying your portfolio, your profile. So remember which one you are, and there are some questionnaires that you might answer to identify what your profile is, and then what is the difference? What is the conservative and how it differs from an aggressive? So the return expectation is different. So if I'm conservative, maybe I'm okay if I get 1% per year, but if I'm aggressive, I want 10% or even more per year. Okay. What else? The exposure to risk is different. Again, if I'm more aggressive, I'm okay to more risky assets like shares and stocks, because I know that in the long term they tend to provide more return. Okay, and then you will create your portfolio with, I would say, just a few ETFs and paying attention the allocation that you want to everyone. Okay, maybe 25% if you have 4, as my example there. Or maybe you will follow, like, if let's say US is the main market and it represents 60% of the global market, maybe you want to have 60% of your investment in the US market. And you can, just a note here, you can buy the US market, the S&P 500, even here in New Zealand, without sending your money to US, okay? Because we have the ETFs in the NZX, the stock exchange in New Zealand, so you can buy here locally the S&P 500 with 500 companies. Good. Again, if you have questions, I will take a look in by the end, so just putting in the question and answer or even in the chat. What else? The second step in this first one is, as I present to you guys, is know your investment goals. Okay, we discussed that, and then you will get maybe an objective. Like I personally, I have my objective is to get 1% per month over the long run on average. Okay, so, and finally, the last bit in this first step is to actually build your portfolio. So what will be the asset classes that you will have? What will be the actual assets, the actual investments in each one of the asset classes? Okay, good. And here you can see some examples. And when building that, you need to know what each investment, each asset might give you in return. For example, historically, the ETF in New Zealand that tracks the S&P 500 gave the investors a return of 13% per year. Remember, quite close to my goal. So it's very likely that if I keep that investment for the long term, I probably would get something similar, like on average 13% per year. I should not expect to have 13% if I start today and 1 year from now to have that. But if I keep like for 10 years, 20 years, probably the average will be quite similar to these 12 to 13%. Okay, good. Moving on. So again, the first step is to build a passive portfolio aligned with your goals and investor profile. The second one is, as I said, stay invested. So every time you have some money, maybe you plan to have every week or every month. So make sure that you are contributing and you are actually following your strategy without panicking if there are bad news, okay? And maybe you want to rebalance. Rebalance could be that approach that I discussed, that, oh, now I have some money, I will buy, as here, I will buy the asset with the lowest balance, so I'm paying less. Or maybe, let's say, every end of the year, you will see how is your portfolio now. You will see which asset has outperformed the others. And then maybe you might sell a little bit of that one and buy more from the others to go back to the original allocation. That might be also a way to do the rebalancing. Or maybe don't do rebalance at all. And then finally, the third step with two components here. The first one is just wait, okay? Remember the future value formula. Is the time the main element here? If you can stay invested for 20 years, it will be good. But if you can stay invested for 30 years, it will be even more, because time will be the component that makes the major impact in your balance, okay? And also put an eye on the opportunities. Remember, for example, right now, the market is down, the prices are low. So if you have somehow more money, now is the time to put more money in your portfolio, because you are buying more because the prices are low, okay? And the worst thing that you might do is panic and sell with those low prices. That will be terrible, okay? So keep your strategy, but with an eye on the market opportunities. Good. Okay, so those are the 3 steps. Let's see what I want to show you guys. Maybe it's a good time to show my actual portfolio and some numbers. But let me just using other websites to show you guys why that idea of the passive, like be okay with the average. So this tool it's regarding the KiwiSaver, the investments, what's the name? The pension plan that we have here in New Zealand. So this, you can see all the performance of every single KiwiSaver option that we have. So let's say that you want to see how KiwiSaver is performing. So, and let's say that you want to see the average of the last 5 years, okay? So if you, and let's say you are a kind of aggressive investor, so you go for the growth category. And if you are able to see my screen, those are all the KiwiSaver plans under that growth category. Basically, it has 80% in stocks and shares, and just 20% in the fixed income, like the government bonds and that fixed income assets. Okay, so note that every single one has a different performance, but for me, it's clear that on average, if you take KiwiSaver plans out of this category, the average is about 10% per year, okay? But note that this one, and this is the fees. So those two ones here are clearly with the lower fees, okay? 0.6, something from 0.6 to 0.8%. And note, let's say this one, the fees are 0.67, so lower than the next one here, that is 89 or more than 1%. And note, so this is a passive KiwiSaver. They just buy the entire market. They don't try to time in the market. And note that they are getting exactly the average. If I take the average of all those funds in this category, it will be around 10%. So why to pay more fees if I can get the average paying lower fees? Okay, and especially if the market is going up, it's okay. Oh, maybe I'm okay paying 2% because I'm getting a better return. But what if the market stay low for long years? So remember, even if your KiwiSaver is not performing well, you still are paying the fees. So I would stay with something that charges me lower fees and get me the average, because how can I know which KiwiSaver will perform the best? In the last 5 years, these are the performance, but nobody knows about the next 10 years. So maybe this one it seems to be the highest, the top performer. Maybe it will be just average in the next 5 years. So that's the idea of the passive investing. Just be okay with the average market, because you are paying lower fees, and over the long run, you will be in a very good shape. Okay. Now let me go back to that, to the main website to show my own portfolios. And again, you can take a look anytime. So this is my portfolio here in New Zealand. I also have investments in Brazil. So if you want to know details about the passive investment strategy in Brazil, just go here and change the language for Portuguese. So you will also even get my local Brazilian portfolio over there. So, but as the focus here is New Zealand, this is the actual portfolio that I have. So let's start with the highest one. So I have 30% of my capital, the invested capital, in the developed markets ETF, okay, or index fund, with companies from US, Japan, like the developed countries, okay. The second main position is the local New Zealand market. So I have this ETF that buys 50 companies at a single investment. That represents 25% of my portfolio. And then I have 19% in the ASX 200 with 200 companies from Australia. And finally, I have around 16% of my capital in the emerging market ETFs, okay? Those are the justification why I have selected exactly those ones. And most of the time is because they charge the lowest fee, like 0.20%, 0.30% per year. That is very, very low. If you compare to your own KiwiSaver, probably it will be like 10 times more, or at least 5 times more, the fees. Okay. This is the actual, it's not so up to date because I can't create this chart anymore in the tool that I'm using to track my investments. But anyway, I put all the years I've been investing in New Zealand. So on average, at least before this year, I was getting like almost 11% per year since 2019, and those are my yearly returns. Okay. Of course, this year, 2022, probably I'm around -7, -8%, because all the markets are going down. And remember, as a passive investor, you just follow the market. You don't try to be better. So you should be okay with the market. If the market is going down, your portfolio will also go down. But that's okay. Maybe it's time to buy more and more if you can. Good. The curiosity here. So the yellow line in this chart is my performance since 2019. Okay, so we had the crash of COVID and then it recovered. But now, as I said, it's going down a little bit in this year. But note the blue line. The blue line is one single ETF that they call the total world. So you can buy just one ETF and it has more than 9,000 companies all over the world, okay? Of course, more of the US, more from Europe, more from Japan, a little bit from emerging markets, a little bit from Australia, a little bit from New Zealand, because let's say New Zealand is quite a tiny market. So, but what I'm trying to show you is if I started all over again, I would buy just one single ETF, and that's the name, the Smartshares Total World, because it has almost the same performance as I'm getting with all my investments, okay, with all the ETFs that I have. And quite similarly, in Brazil, I have a similar performance, and this, especially because I started investing earlier there since 2016. Here you can see my own portfolio performance. Of course, 2022 is the first one that so far is negative, but I'm quite sure that it will not be so bad by the end of the year. And see, in this chart, the yellow one is my portfolio, and the red one is the local Ibovespa, the Brazilian index. And note that over the 5 years time, I'm aligned with the local market index there. So my portfolio has almost the same performance as Ibovespa. The only difference, if you see the yellow line, there are not so much ups and downs, okay? So even during COVID crash, I got like 10%, and the index got minus 50%, okay? I can even show you guys this. If I go to this website, I can show you the performance every single month. So since 2016, note that the worst month for me was exactly the crash of March 2020. But in my case, because of the diversified portfolio, I got only minus 10%, while the market went down 50%, okay? And note that, of course, this month and today it updates, so it's a little bit worse than the figures that I presented. But if you see, I didn't, in spite of this minus 0.06 here, I didn't have any more than 2 months as negative. You can see, oh, 2 months and then something positive, 2 months. So I hope the next one will be positive, 2 months negative and then positive, and many positive ones. So in fact, I'm getting more positive months returns than negative. Okay, good. Finally, I would like to ask you, and I forgot to, let's try to do a simulation here. Let's try to create a portfolio. Or let me just show something for you guys. So let's say, remember that idea of having a single one that I would, if I have a chance, I would start all over with a single portfolio. So let's say this one, let's take the last year and let's compare. So this is my overall portfolio. Let's compare with that single investment, okay? That is the Smartshares total world, and it has low fees, and you buy 9,000 companies at a single time. So this is the one. You see, note something here. So the blue line is my performance, my portfolio performance, and the yellow line is that index, okay? That single ETF. So in other words, I would say, if I can come back in time and just buy that one, I would be in the same position as I am today. But note that how many ETFs I have over here and in Brazil. So see, I have all of these. It's, I don't know, 40, because in the beginning you start doing something that was not so good, and then you realize that the key word is simplification. So now I would say I would have just one, and that single one would be very good, very not that good because the markets are down, but it would be aligned to all the investments that I have. So why not to go for a simple thing that is just buying one and just set a kind of a set and forget. Okay, good. So that is all I have. Let's see if you have questions. Maybe we have some minutes. Feel free to put in the chat or in the questions and answers session if you have questions. Are you okay? Do I have questions from someone? Just feel free to type whatever you want. There is one question from one attendee. Could you apply the same concept of set and forget with crypto? Okay, so I would say I have crypto in my portfolio. I didn't mention here because I have just 0.3% of my total portfolio in a crypto ETF. So all about ETFs. I don't buy single companies or single cryptocurrencies. I back in Brazil, I buy one ETF that has around 10 crypto, including Bitcoin, Ethereum, and others. But it's quite volatile. So personally, if you ask me, I wouldn't recommend even the aggressive investor to have more than 2 or 5% on crypto. In my case, my goal is to have like 0.5%, but because crypto market is down, now I have just 0.3% of my entire portfolio, okay? And just out of curiosity, if we go back, let's say, to that comparison here, let's say if you compare that with Bitcoin in the last year, okay? So see, remember the previous two lines, the blue and the yellow, were my own portfolio, my global portfolio, and the yellow was that total global ETF. And note this, let's say green line is the Bitcoin performance. So I would say in the last year, I have been better than if I had only crypto coin, because 1 year performance, my portfolio is negative 1.5, as you can see. That total world ETF is -2, but Bitcoin in the last year is 26% negative. So maybe it's not a good approach. But anyway, yeah, and if we take just since the beginning of the year, just as curiosity as well, my portfolio, the blue line, is -13. The overall single gluten-free ETF is -12. And note that Bitcoin is -37, okay? So that is the point. I wouldn't recommend more than 1% on crypto because it's so volatile. I have, as I said, 0.3. Good. I have more questions here. Let me take a look. Okay, and yeah, I hope that's it. And someone in the chat. What is your view on buying shares through Sharesies? Do you recommend? So, okay, see, I'm not a financial advisor. I'm more of a financial educator. I would, the platform that I use is this one. It is Invest Now. They don't charge any fees, like monthly fees, and even to buy something, they don't charge you. So it's like it's a platform that you can buy funds from many fund managers. Okay, the name is Invest Now. You can buy the what I call the Smartshares, the ETF issuer in New Zealand, and those are the passive. Okay, because many of those funds here are active, the ones that over the longer run not necessarily outperform the index that they benchmark. So what I'm buying is from these Smartshares, and they have like 37 funds, ETFs, sorry. So you can buy, remember I showed you guys the total world. So this is the one, it charges you 0.40% per year, and it buys the entire market, like 9,000 companies. Good. And then you asked me about Shares. Okay, Shares, it's fancier. They have an app, and in that app you can buy individual stocks. You can buy Tesla, you can buy Air New Zealand, you can buy something from Europe, but there is like a commission, there are fees every time you do that. I think that is kind of subscription. So I try to avoid those fancy apps, because probably if I have them, I would be willing to buy specific single companies' shares, and that doesn't work as per my experience and as per the passive strategy. So I don't have Shares. I know that there are some comparisons that you might find. For example, these Money King NZ, you can find a comparisons, but they will basically say that Invest Now would be cheaper. Okay. Oh, what is that? Yeah, I don't know. Maybe so. This is the website. You can search for that comparison. So I don't have Shares because of it will be more expensive than the Invest Now. That's for sure. Good. Yeah. So if you maybe search here, there are many comparisons. But yeah, so maybe this one is the one. Good. Do I have something? Yeah, our time has gone. So just put in the chat the name of the platform that I'm using. It's not a financial recommendation. So if there are no more questions, thank you for attending the webinar. Feel free to contact me. You have now my website, and I wish you the best on your investments.